Ever heard that a fixed-rate mortgage means your payment's set in stone? Don't fall for it. While the interest might stay put, property taxes and homeowners insurance can wiggle like a jellyfish. That monthly bill, it could still change. Think of it like going out to dinner. You pick your meal, the loan, but the tax and tip, taxes and insurance can make the final bill higher than expected. So, you're ready to dive into the wild world of home loans? Buckle up. We're about to break down interest rates, those sneaky little numbers that can cost you thousands. We'll make it fun, promise. Think of this as your crash course in all things mortgages. By the end, you'll be tossing around terms like APR and discount points like a pro, ready to unlock the secrets to scoring the best deal on your dream home. Let's go! Remember, knowledge is power, especially when it comes to your money. Let's get you financially fit. Imagine interest rates as the rent you pay to borrow money for your home. You're essentially renting that big old pile of cash from the lender. The lower the interest rate, the less rent you pay over time. Sounds simple enough, right? Well, hold on to your hats because things are about to get interesting. Think of it like this. You're at a fancy restaurant. One dish is priced at a cool 10%. That's your interest rate. Another dish, same deliciousness, is only 5%. Which one are you choosing? The 5% dish, of course. You get to enjoy the same meal while saving money. That's the magic of lower interest rates. Now, these rates aren't just random numbers thrown at you like darts. Oh no, they're determined by a whole bunch of factors, kind of like a financial cocktail. We're talking about things like the overall economy, inflation, that sneaky price hiker, and even the lender's own costs. Understanding how these factors influence your interest rate is key to snagging a great deal. It's like knowing the secret ingredients to your favorite recipe. So, are you ready to become a mortgage master chef? Let's keep cooking. Remember that economic stew we talked about? Well, the ingredients are always changing. The economy is like a roller coaster, full of ups and downs. When the economy is booming, interest rates tend to rise. Think of it as the price of success. On the flip side, when the economy slows down, interest rates usually follow suit. It's like a sale at your favorite store. This is when those sweet low rates start popping up. But don't wait too long to grab them because just like that sale, they won't last forever. Inflation also plays a big role in this financial dance. When prices rise, so do interest rates. It's like a game of tag with one chasing the other. The Federal Reserve, the big kahuna of money, tries to keep things in check by adjusting interest rates. So you see, understanding the forces behind these rate fluctuations is crucial for making smart mortgage moves. It's like checking the weather forecast before heading out. You want to be prepared. Now let's move on to some tips on how to secure yourself a fantastic rate. Lenders love borrowers with sparkling credit histories and a healthy financial track record. They're like the VIPs of the lending world. These borrowers get access to the best interest rates, often referred to as prime rates. Think of it as the first-class ticket to homeownership. So, how do you become a prime-time borrower? It's all about building good financial habits. Start by paying your bills on time, every time. This shows lenders that you're responsible and can handle your finances. Next, work on reducing your debt. The less debt you have, the better your debt-to-income ratio, DTI, a key factor lenders consider. We'll dive deeper into DTI in a bit. Think of it like this. The lighter your financial load, the smoother your loan approval process. By following these steps, you'll be well on your way to joining the ranks of prime-time borrowers. And trust me, it's a club you definitely want to be a part of. Section 5. Credit Score Chronicles. Your financial report card matters. Your credit score is like your financial report card. It tells lenders how well you've managed your credit in the past. The higher your score, the better your chances of getting a lower interest rate. Think of it as your golden ticket to mortgage savings. A good credit score shows lenders you're a safe bet. You're more likely to repay your loan on time, which is music to their ears. On the other hand, a low credit score can be a red flag. It suggests you might be a risky borrower, leading to higher interest rates. Don't worry if your credit score isn't perfect. There are ways to improve it. Start by checking your credit report for any errors. You'd be surprised how often mistakes happen. Then, focus on paying your bills on time and reducing your debt. Remember, your credit score is a journey, not a destination. By making smart financial choices, you can boost your score and unlock those coveted lower interest rates. Now let's explore another crucial factor, your debt-to-income ratio. Section 6. The debt-to-income tango, finding the right balance for loan approval. Imagine your income as a delicious pie. Your debt payments, like credit cards and student loans, take a slice of that pie. Your debt-to-income ratio, or DTI, measures how much of your pie is eaten up by debt. Lenders use this ratio to assess your ability to repay your mortgage. A lower DTI is like having a bigger slice of pie left over for your mortgage payment. Lenders love this. It shows you have room in your budget to handle the loan. A higher DTI, on the other hand, can be a cause for concern. It suggests you might be stretched thin financially. To improve your DTI, focus on either increasing your income or decreasing your debt. Think of it as a balancing act. The goal is to find the sweet spot where you can comfortably afford your mortgage payments without feeling overwhelmed. Remember, your DTI is a crucial factor in the loan approval process. By keeping it in check, you'll increase your chances of getting approved for a mortgage with a favorable interest rate. Section 7. Lock it in. When to secure your rate and outsmart the market. Once you've chosen a lender and are happy with the interest rate offered, you can choose to lock it in. This means your rate is guaranteed for a specific period, usually 30 to 60 days, even if market rates fluctuate. Think of it as insurance for your mortgage rate. Locking your rate can be a smart move if you're worried about rates rising before you close on your home. It provides peace of mind knowing your rate won't suddenly jump up, potentially costing you thousands of dollars over the life of your loan. However, if rates are trending downwards, you might consider waiting to lock in your rate. Of course, this involves a gamble. Rates could go up, leaving you with a higher interest rate than you initially anticipated. It's a game of risk versus reward. Consult with your lender to determine the best time to lock in your rate. They can advise you on current market trends and help you make an informed decision. Remember, timing is everything. Section 8. Shop around and compare. Don't settle for the first offer. Don't jump at the first mortgage offer that comes your way, no matter how tempting it may seem. Shopping around and comparing rates from multiple lenders is crucial for securing the best deal. Think of it as a treasure hunt for the lowest interest rate. Each lender has its own set of rates and fees. What one lender offers, another might beat. By gathering quotes from several lenders, you can compare their offers side by side and see which one offers the most competitive terms. It's like finding a hidden gem. Don't be afraid to negotiate. Lenders expect you to shop around and are often willing to lower their rates or fees to win your business. Remember, you have the power. Be assertive and don't settle for anything less than the best deal possible. By taking the time to shop around and compare offers, you could save yourself thousands of dollars over the life of your loan. It's worth the effort. Section 9. The mortgage maze. Avoid these common missteps. Navigating the mortgage process can feel like traversing a maze. There are twists, turns, and potential pitfalls along the way. But fear not. By being aware of these common missteps, you can avoid them and ensure a smooth and successful home buying experience. First and foremost, don't overestimate how much house you can afford. Just because you qualify for a certain loan amount doesn't mean you should borrow that much. Consider your other financial goals and ensure your mortgage payments fit comfortably within your budget. Secondly, don't wait until the last minute to get your finances in order. Start early, check your credit report, pay down debt, and save for a down payment. The better prepared you are, the smoother the loan approval process will be. Lastly, don't be afraid to ask questions. Your lender is there to guide you through the process and address any concerns you may have. Remember, knowledge is power. The more you understand about mortgages, the better equipped you'll be to make informed decisions. By steering clear of these common missteps, you can confidently navigate the mortgage maze and achieve your dream of homeownership. Congratulations, you're now well on your way to becoming a mortgage master.